Welcome to another episode of Running Greenleaf. Today we are going through the residential market, what we're seeing in our apartment and mobile home communities. So we also have our updates on distributions and what the end of the quarter looked like. So we're excited to get started and go through things here. Okay, so we're going to start with distributions. This one is kind of always the focus of our end of quarter, right? And apartments, we're going to touch base just on kind of how the year went and how things wrapped up. But in general, we had the majority of our mobile homes that are making distributions, and then about a third of our apartment communities that are making distributions as well, mostly stuff that's on our in-town Memorial Drive area in Atlanta. Our other apartments, which we have some stuff that's up in Gainesville, Georgia. We have stuff in North Atlanta, our Chattanooga apartments, and still Charlotte. Those ones are not making distributions, and we're going to go into the reasons behind what's going on there. So,
yeah. So let's go ahead and start with let's talk about what's working and what's going well. The business focus historically and continues to be is retention. At our year-to-date retention for 2023 was 70%. Compared to a market, we did a lot of research on the market, and it's interesting to see, in general, retention is around 50% for the market across all asset classes in multifamily. But what we're seeing in the market happen is that Class C multifamily retention is rising because the cost of moving is becoming less and less affordable.
Yeah, we saw that at 65%. And again, there's not tremendous data on kind of how's the market going. And people's definition of Class A, B, or C is vastly different sometimes. But the information we could see is that more affordable units, Class B, lower, Class C, are seeing retention that's in the 60% range because cost of moving is prohibitive for most people, especially if they look at new rents versus renewal rents. And that's something that we do too. Our renewal rents increases are much lower than a new unit rent.
Right? Exactly.
That's coming out.
And let's talk about why is retention so important. We talk about this every quarter. It's it's just so valuable to our company because retention ties into not only is it a measure of quality and affordability and service, but it's also it really gauges on how much money we're going to be spending. If we have a ton of turnover, we need more staff. Yeah. We need more people leasing. We need more maintenance people. We need more materials. We need more vendors. If we have less turnover, we need less of those things. So overall, compared to the market, with our retention being higher, that we found that our increase of expenses we're actually beating the market with over the last couple of years.
Yeah, we feel very good about that, and that's what we've been focusing on the whole time. So it's working, and we're doing better than the market is on our retention rates. Other things that helps with is you look at retention. That means we're going to have residents that have been at a community longer, and the longer that people are at a community and the more they know each other, the safer that community becomes, right? So our average lease term now is 42 months. So that means we have, people that have been there almost 4 years on average in our communities. So we feel like that's an indication that we are priced appropriately and performing well on the communities that we do have.
So how does higher retention impact our revenue?
Yeah, I mean, if you think about our revenue rates, high retention, our renewals are based on a rate that people will stay. So we may have between 3 or 4%, 5% increases on renewals, right? But that means we're not going to have a lot of new resident fee income from a new move-in, like a pet fee or any of that kind of stuff. Whereas a new lease, so that's 70% as a renewal. A new lease that 30% chunk is going to have a much more significant rental rate increase on those units. So we think about our overall blend this end of the fourth quarter. And then for the total of 2023, our revenues were up 6.3%. So from 2022 to 2023, our overall revenues are up 6.3%. But that's a blend. That's an increase on renewals, and then it's an increase on new leases that are coming in to the portfolio. And what we saw was between 3 and 5% increases on renewals, and we saw 12 to 14% increases on new leases. So when someone leaves, we're able to re-rent that unit for 12 to 14% more, is what we saw on average for the year. And blended together, that generates just over 6% revenue increase for the year. Now, market-wise, that's well ahead of what market information was that we could find.
Yeah, just about all the market information, they saw that really the Southeast and the South saw about flat rental growth for the year to maybe a little bit down, specifically in the Class A part of the market, because looking at the data, 2023 was the largest development year since the mid-1980s. 565,000 units were delivered in 2023. So the market saw some softening kind of on the top end of the market. But I mean, overall, it was fairly flat. There was some rental increases on some of the stronger markets that we operate in, where Chattanooga, from a market level, saw 7 to 8% rental growth. But overall, where we are, the market saw pretty flat growth.
Yeah. So they're talking. The market information is talking about new rental rates. So that when we're seeing 12 to 14% rental rate increases on new leases on turnover, the market was essentially flat. Mm-hmm. Chattanooga saw 7%, but that was second highest in the country behind New York.
Absolutely.
On the information that we could find, and we'll post some of the links that we have for where we get our information. But so we're very pleased with the revenue gains that we've been able to generate. And let's talk a little bit about revenue versus rent, right? So rent gains in a lot of what reported is the change in the asking rental price from one period to another. So if you're asking, say, $1,200 for a 2-bedroom apartment, and then the next quarter you change that and you're up $1,250 is the asking price, that $50 increase, that's what people in kind of the industry analyst roles are looking at and saying that's how much rental rates increased. We look at that part too, but we really look at how much did overall revenue increase, which is just collected. Doesn't necessarily matter what you're charging or what you're asking, it's more what did you collect. So we look at revenue as our number for what we're assessing. And that's our number that we said went up 6.3%.
Yeah, so to build on to really what's working well is let's talk about our debt for a little bit. Our philosophy with debt is buy a property, renovate the property, stabilize the property, and refi to long-term fixed debt as quickly as possible. And we did give or take 4,000 apartment units over the last 10 years, and that was really our MO. Over and over and over again. So almost all of our apartment buildings that we have are on long-term fixed debt, and all but really one of our mobile home parks is on long-term fixed debt. So going into 2024, with these rental or with these interest rate increases, we only have one very small mobile home park that debt is coming due, and we're negotiating with the lender to renew. But overall, all of our apartment debt is fixed till 2026, 2028.
And that lender's a local community bank. So that's not Fannie or Freddie or agency loan that we have coming due. It's also relatively
very small.
It's less than
a couple $100,000.
2% of our overall debt, on our stuff. So it's pretty small. But and we have nothing coming due next year.
Right.
So everything we have is long-term fixed rate, done when interest rates were pretty darn good overall. And that's been our strategy was always like, how do we lock in long-term fixed rate debt? So most of our loans we're looking at are coming into like the 2027, 2028 range.
Right.
Exactly. So we feel very good with that strategy. That's a little bit of why we're in the position we're at, where we are holding some of our assets here, mainly the portfolio we have left. So we want to talk a little bit now about what's not working or what we're really seeing in the market that's impacting how these deals are performing. Obviously, we would like to have, our goal is to create quarterly distributions and generate passive income. And we would love to see distributions on everything. But it doesn't always tie out that way. And when we think about what's not working, what's really driven us kind of at the end of the year is margin compression. And we'll go into the specifics of how that has played out. But Q4 is where we always see our taxes and insurance numbers finalized for the year. We're forecasting what we expect them to be throughout the year, and we reserve for those numbers. If you've been with us a while, we're reserving for taxes, insurance, and operating costs. And as those go up, the reserve thresholds that we must target for our deals, where we feel like we're in a healthy financial position on our balance sheet, that number increases to coincide with what our costs are going to be on the materials, OpEx side, taxes and insurance. So we forecast for that for the year. And by paying our taxes and insurance at the end of the year, we kind of get our real numbers. And when those came in higher, not only do we have to use our reserves, but it also triggers us to have a higher reserve threshold that we need to reach. So we have a couple deals, and this is out in all this. The very specifics are out in each deal's financial performance, but there's good money on the balance sheets. It's just we paid out more in taxes and insurance, and then therefore also increased our reserves. So it's kind of a little bit of a double whammy on that when we look at our distribution calculations. But let's kind of dive into the actual specifics of what that means. So
yeah. And philosophically, we talked about, with the portfolio that we still have in our apartments, we've sold about 75% of what we've bought, and we have about 25% still left. And the philosophy on why do we keep holding these is that we continue to see rental rate growth, we continue to see margin expansion, and our discussion with all of you has been, if that were to change, we would look to basically unload these properties. So this is really, one of the first quarters that we've seen that we're still seeing rental rate growth, but we're seeing expense growth really outpace that, specifically in taxes and insurance. But, talking about, materials as well, materials year over year, we're up 34%. And, we have a highly trained staff. We've been in this business for, about 15 years now. And our average tenure with our apartment employees is pushing right about 5 years. So our teams know how to efficiently do things well from a cost standpoint. And they also understand our philosophy of doing business, which is basically strap on a tool belt and let's get it done. So we're always looking to basically how do we do things in-house? How do we basically not pay a trade vendor that's right now prices are through the roof, and do things internally. So I overall our approach is working, and we are beating the market, but we are still being impacted by cost increases. Yeah,
overall operating costs on information we were able to find rose about 28% in 2023. So operating all apartments got more expensive, and the market we were talking about had flat revenue growth. So flat revenue growth with 28% increase in expenses is not the margin direction you want to see things happening in. But we, on the other hand, we had over 6% revenue growth, and our overall expenses were up 23%. That's what and we knew we were going to see some expense growth this year. So it wasn't like we were expecting 0, and we got 23% overall. But that 23% increase, we start looking at things on a per unit basis. Our taxes are now on average $1,300 a unit. They were up 13% per unit this year. Our insurance is around $600 a unit, and that's up 23%.
Well, let's play. So when we started in the business, really until, let's just say, give or take 2015, insurance was kind of a flat number at $250 a unit.
Yep.
And taxes in general, depending on where you were buying, but in general, they ran $300 to $500 a unit. So both of those are up 2 to 3x, in call it a 5 to 7 year
that's just now.
period.
And if we look at, and then to wrap that up, materials was up 34%. So almost $1,300 a unit is what we're seeing. But we look at underwriting for new deals that are happening in the market, and insurance, a lot of insurance is coming out at $1,100 a unit, $1,200 a unit. So there's a lot of insurance growth still out there, and taxes as well. As valuations went up significantly over the past 2-3 years right now, and municipalities are raising their assessed values, and which coincide with market increases, and then that also raises the amount that you've got to insure. So it's kind of like feeds into itself on those. So those couple of things where we see large percentage increases, you have to have revenue growth that offsets that. And overall, just taxes and insurance, if you mentioned taxes are up 13%, insurance is up 23%, but in real dollars, we need a 4.7% increase in revenue, pure dollars in, to cover those increases. So that means when we look at 2024, we put in our budgets, like, okay, we need a minimum of 4.5% revenue growth to make up for the taxes and insurance margin compression. If we add in materials to that, we're going to be just under 8%. That we have to add to revenue to make sure that our margins stay the same. So end of 2023, our operating margins definitely contracted, and that is why we have some of these deals that are not making distributions. We look forwards going into 2024. We need to see revenue growth, really rental rate increases that are going to hit 8% to keep up with costs that we saw from 2023. Now, that doesn't include what's going to happen in 2024 and where are these costs and insurance and taxes going to be in 2024. So we're really aiming for even higher revenue growth. We think about the market as a whole. There's going to be increases in rental rates. There almost has to be, unless you're going to have operators go more underwater and subsidize, more of the rent by taking on losses. We were in a position that our debt was all fixed. So when we talk about what was working, all fixed rate debt, we didn't have that cost. But some people had interest rates that went to 7, 8, 9% on floating rate debt, and their cost of debt doubled. So their margin compression outside of operating costs was significantly larger.
Right. And Fannie and Freddie are still doing really, really well on subsidizing the market, meaning that you can still get a 10-year fixed rate loan for about, give or take 200 basis points over the 10-year treasury. So 6%. And you can normally get at least 5 years interest only. So your carry costs for 5 years are only 6%. It's very healthy compared to the commercial market that we've seen a very different results in.
Yeah.
So there still is plenty of opportunity to basically invest in these and basically create some cash flow.
Yeah. But we see opportunity-wise, our take on this is that, we did see margin compression. If that continues, right, it's either a situation where there's going to be some great buying opportunities because there'll be positions not only on OpEx but including debt as well where they have to be exited or something has to happen. We're started to see a few deals that are already coming out to market in early 2024 that are retrading below what they were purchased at only 18 months ago. So we're starting to see some discounts on deals. Maybe that trickles into us being able to buy them. We've been optimistic or saying that we expected this to happen for years, but that's kind of you keep saying something, eventually you're right. I don't know if that should be our strategy, but you feel like operating margins contracting that much are going to make it challenging.
One of my favorite quotes I heard recently was, I predicted 10 of the last 2 recessions.
10 of the last 2, yeah. That sounds about right. So that's where we're at on the operating margin. Like, we got a lot of things that are going in the right direction, and we got some stuff that's some definite headwinds that we are facing that's in the multifamily space as a whole. We feel good with our retention. We feel good with our ability to add revenue gains. We feel good being in our affordable price versus Class A. We think there's a little more stickiness there and longer term residents. So overall, we're going to look at the next, first quarter and second quarter of 2024 and really assess what these margins are looking like at that point to dictate our investment decisions, whether we're going to add or sell some units into our portfolio here.
Yep.
So another part we want to talk about is just opportunities and some of the redevelopment stuff that we have in the works right now.
Well, so some of the redevelopment is pure scrape it down and build up new. Some of the redevelopment is like Kingstown, right? It's almost like just a rejuvenation of the property that we've already owned for a long time.
Yeah.
And we'll be seeing, we've been doing that on Kingstown, that we bought this as kind of very much a Class C affordable rate housing unit that rents we were targeting $800 to $900, and the market really leapfrogged us. And so we're going back and renovating all the units, and we're getting rental rates closer to $1,300.
Yeah, and we're only doing that as someone moves out. So if you've got 70% retention, you've got people that have been there, on average 4 years, there's not a whole lot of them that you're turning over, but we're doing that turnover basically one at a time out of cash flow. So every quarter, we're able to turn a unit or two, and that kind of utilizes our cash flow from that quarter.
So a property like that doesn't make any distributions, but we were creating a ton of value by increasing our rates by give or take 40, 50%.
Yeah.
And so in the upcoming future, in the next, call it 12, 24 months, we'll see the same opportunity at Saddle Creek, which is our affordable housing property in Alpharetta, that the rent restrictions expire. and we'll be able to go unit by unit and take rental rates from, right now we're restricted to around 1,000, 1,100, and the market is over 2,000. So not necessarily that we're going to go chase that 2,000 number, but we can easily go chase 1,500, 1,800, and be in a really good position there, unit by unit.
Yeah, and that's going to require, a tenant that does not renew, and then a situation where we have one unit at a time that we're able to renovate and do that one unit. It's not a full remove everyone kind of situation, or not a hard down asset situation where there's blown out windows and all that stuff. It's like they're fully occupied, and we're going to go into one unit at a time, and it's not working on weekends. It's not working overnight, because people are actually living there. You can do stuff during the day, but you have to be very conscious of your residents that are there and not creating a disaster while doing it.
Yeah, so we love the opportunity to take a property that we know how to operate, that we know the market, and reinvest in that property to create a lot of value, like Saddle Creek and Kingstown, versus going out and buying any other property that we don't know as well, paying a premium for that in this market, when there's great opportunities that we really already have in our portfolio.
Yeah.
And that really goes to kind of the next part of it, of kind of the more traditional development, which is let's scrape in and build something new. We've been working on this at one of our mobile home park, Barnes, and we're really going through the rezoning process now. We're meeting with city council, meeting with the residents to really see what all the asks are before we really start the project. But currently it's 15 mobile home units that we have the opportunity to basically rezone and fit. We can fit up to 44 townhomes on. And rental rates on the mobile home units around $400 to $500 a month, where the townhomes we can achieve closer to $2,000. And for that market, we can develop more effectively than we can go buy new stock.
Yeah. So it's a good opportunity on the redevelopment side there, but it takes a lot of time. I mean, it's occupied. We have long-term residents right now. We're gonna operate as we go through the process and the discussion of what we can do and how it can be done. And then we'll have more information and kind of updates each quarter. We're meeting with city council, we're meeting with zoning to figure out like what can actually be done here. If any of you have done that before, it's a lengthy process. There's, one or two meetings a quarter. So it's not that you just show up and Monday, Tuesday, Wednesday, you knock this stuff out. This is a longer term process. We estimate it'll probably take us like 14, 15 months before we get to an answer of what we can and can't fully do on the project. So that's at Barnes. And then we talk about the station. That's another one where, we purchased the station in an opportunity zone, and it is a commercial asset, but it's right in an area that's seen a bunch of redevelopment and new apartments that have been added. I mean, we did mention that there are apartments kind of being added everywhere, but it's a good opportunity for us to take an asset and turn it into housing development.
Right. And when we were buying the station, we were competing against other groups that wanted to rezone it, and the seller just didn't have the time or patience to wait 2 years for that rezone to happen. So we bought it as is and said, listen, we're more long-term minded. We can operate as a commercial property, and then looked at the rezone in the future.
Yeah. So we're starting that process now. And again, very similar is talking with the city to see what does their timeline look like? What would they be willing to put here? I mean, you can just look at the zoning map and be like, oh, this is zoned to put exactly this here. It's like, but it doesn't necessarily work that way. You still have to, you don't just start building. You have to talk to the city and figure out what amenities do they want to see and what's best for the area. And we have a elementary school within a mile, right on the same road, right down the street here. So there's considerations that go into all that, all those kind of things. So we are working on that with the station. So we'll have more updates around that. It's going to be a pretty cool project, both of them, the Barnes and the station, as we can get through to that. So we're feeling very good on those opportunities. We're feeling good about reinvesting the stuff we have. We're going to assess kind of how the market goes over the next first and second quarter to really dictate what we're going to do with the assets we own that are not in that redevelopment or value add space right now. So, yeah, cool. All right, that is it for the fourth quarter. And again, all of our distributions that are going out on the 20th. All of the reports will be in your portal on January 20th as well. And that should hit your accounts.
What about K1s?
K1s, taxes, always a good one. We will have our K1 reports out by the end of February. That is our goal for this year. We are typically, we're filing in multiple states, so we're getting all of our state filings done, and then we will post those to your investor portal as well, and that'll be the end of February for all the K1s. So.
Excellent.
Cool. All right. Thanks for watching. We'll get back to it. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.